Well, welcome everybody to our Straddles and Strangles webcast. I'm Connie Hill, Senior Manager and Educational Coach here at Schwab. Happy that you joined me here today. You know, the strategies that we talk about and focus in this class are really just these two, straddles and strangles, but we can be long, we can be short, or we can combine the strategies together. And so we're going to look at examples of many of those things today. And I'm also going to solicit your input as we discuss a couple of things here. So I've got a big schedule planned for us. So hold on tight. I am joined in the chat by Cameron May. I'm happy Cameron is here. He's going to keep his eye on the chat for any questions that maybe I can't get to, but I'm going to keep my eye on the chat because I like to address your questions as they come along. Now, if you're listening to this on the recording, when you have questions, put your questions in the comments section of YouTube, because I go back and look at those during the day so that you can get your questions answered as well. Hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS. And we'll post educational content, things we're noticing about the market, things that are going on that we think you might find interesting. We'll share them with you. Well, let's go through our disclosures and get down to business here. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for education and informational purposes only. Don't consider it a recommendation. We'll be using the Paper Money software application. Is the most robust version of Thinkorswim that you'll download to your computer. It's a little different than the web version or the mobile version. Paper Money mimics the live account really nicely with a couple of exceptions. And one is that it does not assign short options early. Your live market absolutely can and will assign options early. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. All right. Want to let you know some workshops that will be coming up soon. Over the weekend, they had the Sacramento workshop. Everything sounded like it went really well. So next up, San Diego, Denver, Dallas. Okay, we're going West Coast, a little bit more, a little east and further east. So if you can get yourself to any of these, you will really enjoy what we do for you there. It's free. You get it because you're an education or you're a client here, and it doesn't cost you anything to join. All right. If anybody went to Sacramento, would you go ahead and chat in how that event was for you if you happen to have been able to go there? All right. We'll always take a look at the current market, see what's going on, and we'll talk about different strategies or rather the trades that we had in play, and then we're going to go through some new ones as well, and that's where I'm going to request your input. Now, somebody said that I missed the AMD. We haven't talked about AMD yet. We're going to. So you are just fine and in time. All right. The land of the Super Bowl champs, Jim Wood says, yay, yes, I was going to say, you must be up in Seattle land, maybe, where the Seahawks play. Let's jump over here to Thinkorswim. Now, market seems to be at least continuing right now on an up vein, right? We can see what the SPX is doing here today. On my chart, we're going to use a couple of things. One is the ADX, which shows us the strength of the trend. Sometimes that might be helpful for some things. We're also going to use what's called the market maker move. And it is a script that does some nice calculations for you. It'll put in what the market maker move is for a particular stock for whatever the event is. And then it'll graph the two little lines right here. And I'll show you when we get to an individual stock. But for those of you that do not have this yet, this script, I'm going to put it out here in the chat, and I'll also post it in one of the charts we look at here. I'll post it there for those of you looking at the recording here. All right. So SPX looks like it's headed up. NASDAQ looks like it's recovering a little bit today. It sold off quite a bit harder last week than, say, the S&P did. The S&P is almost back up to previously where it was. And if this is what we're seeing in the markets, what should the VIX be doing? right? Should the VIX be higher or lower if we're seeing the markets go up? Well, yeah, we would expect the VIX to be a little bit lower, and it is pulling back a little bit today. What is it at? 1729. So it's still in a range where maybe it's a little bit elevated, and we're going to notice that in option premiums. What could happen there? Well, they could be a little bit more expensive. They also might sometimes have wider spreads, and I have noticed that in the market lately. Things that usually have pretty tight spreads, they are a little bit wider, and that's going to impact us a little bit today because we'll be using some of those options that maybe don't have as tight of a spread as we normally might like to see. All right, first thing we're going to look at here trade-wise is something we did maybe about 3 weeks ago. And I can make this even a little bit bigger. I'm going to make this as big as I can. All right, hopefully you're able to see that. That's about as big as I should get it on the screen. We did something way in advance. When earnings season first started, we put on a trade on Airbnb, and we bought a long call and a long put. That's a straddle because we used the very same strike price. We bought a 133 call and a 133 put. And here are the values that they had. We paid $620 for the call and $605 for the put. Now, the purpose of doing this a while ago was so we could see if the option prices changed and if implied volatility swelled enough to the point that it looked like maybe we were making money on both of these options. Well, as it turns out, and I'll show you the chart, Airbnb dropped a little bit. And so for a period of time, before it dropped, for a period of time, it did get slightly bigger, okay? Meaning the premiums were a little bit bigger than 620 and 605. But then it started to drop down, and then the put became a lot more valuable. You can see here it was worth $12.70, and then the call significantly less, but the overall net effect had us up here about $309. Now, the intent of this trade was not to hold over earnings, okay? So we went ahead and closed it out and just didn't even go through the earnings. We just went ahead and took the trade down, said, let's capture this profit, and we were done with this particular trade. Now, we didn't do a lot of follow-up with this. We looked at it once in a while when we'd have our class, but there wasn't anything really exciting all the time to show you about it. So that's why I captured it on the day when I said we're going to just go ahead and sell it. Went ahead and captured that image. Now the chart, A, B, and B, there we go. You can see we got in here, clear up here. That was the 23rd of January, okay? And we just held on all this time, and this is where we really got a big move on it. And then this is the day that we got out, okay, where I've got kind of that golden. And they will announce earnings this week. It's not actually going to be one of our trades that we're going to do this week, but this actually does give you a good look at that market maker move. Shows up here, $7 or 7.53% is the estimated move that's priced into the at-the-money options. And the market maker move, which is basically the expectation of movement for this event, and it doesn't always have to be earnings. This one and the ones we'll look at today are because of earnings. Looks like it's in the range of about $9, either up or down. We don't know what direction, right? The news will come out. We all got to find out together. But this yellow line here and down here are indicating, okay, where is this $9.12 move? Where would it put the stock? Well, either up here near 130 or down here around 111, 112. All right. Stegall says, does the market maker move show up on a 30-minute chart as well? We can go see if it does. I don't usually typically look at it in that short of a time frame. Let's see, let's get our intraday. And you said in a 30-minute chart. Okay, we'll go to 30 minutes. Let's see if it shows up. Yeah, guess it still does. And these are basically the same level. So it's not doing it at smaller increments because it prices out for that event. So yeah, I guess the answer is yes, it does. Let's see, John, let's see. You have a call on the top and a put on the bottom, correct? When we were talking about the Airbnb, yeah, we had a long call, long put. Option says, have you tried the straddle strangle strategy on index options? We have not in this class done that, but I have done similar things in the index options class I've covered for Ben before. And this absolutely could be, you could practice this in your paper account and try it out with indexes as well. SPX, obviously a good candidate. Yeah, thank you, Wiley. Wiley's letting us know when that index class is, index options. If it is not earnings, will you find out what the event, the market maker move is based on? So there are some things that might be kind of known, okay, like an earnings announcement. We know about it in advance. But sometimes the pricing comes in for other events, like, say it's a biotech stock, and they're waiting for FDA approval, and the FDA has said, hey, on this particular date, we will tell you how, what we've decided about your drug. So that comes from the news and kind of keeping on top of what's going on with that stock. Something else could be like a lawsuit is due to be determined on a particular date. And so the date is out there and you're keeping track of it on the news when that date might be. So you have to do a little work to figure those out. This with earnings makes, they're right here on the chart, so it makes it really easy. But there's nothing necessarily automatic that's going to flag you about it. Okay, you do have to kind of see how that is. All right, I want to show you AMD. Now, AMD, we got in a couple days before they announced. So you can see this is the day we got in. They announced that evening. No, is it next evening? Let's see. They announced after the market closed on Tuesday. Okay. So the first day of trading was Wednesday, and they gapped down really big and continued to drop for a couple days. Now I've got a pink circle here, and that pink circle represents we had sold. Well, let me show you the trade. We sold a call and a put. We did the 247.50 straddle. So we sold the call, we sold the put, we brought in a nice little credit here. And then we put on some hedge legs, right? So that we weren't naked, a long call or a long put. And that was the purpose of putting on the strangle, which is a little bit out of the money, so that the expense of that coverage, so to speak, is definitely lower than the credit you bring in on the options that you sell. Okay, so this was what it looked like at the end, about a $13 credit, so $1,300 credit. Now, what happened was the day it started trading on the 4th, bright and early when we could see, yeah, it definitely is going to kind of keep going that direction, we went ahead and we bought back our short 247.50 put. That put us at a pretty decent loss at that point. So I want to show you the math here, because I want you to see kind of how we approached this and managed it. Okay. So 1,300, oops, yeah, I'll do it with the decimals, minus 36.05 gave us a value of $23. So when we went and bought back that short put, that's how much in the hole we were, $23.05. So from that point on, we would just mainly focus on this 225 put and see when did it get past 23.50. When did it get to a point that it was higher, that it was maybe at a point that it was worth cashing in on, so to speak? Okay. We actually did not, we did not get out of it until the next day. And you can see my timestamp here is 12:21. So the next day, after a while, it had dropped pretty significantly to the point that it was like, okay, there's a good profit there. All right. So we went and sold that option for $32.30. That more than made up what we were down on. So we ended up on this with about a $925 profit. Okay. So, in an ideal world, if every trade could work out like that for you, that would be just ideal and would love it. Trades don't always work out that way, though, do they? Sometimes they make a move and you think, okay, it's going to really go this direction. It might go that direction for a little bit, and then it might totally change a few minutes later. So you never know how it can happen. Now, I don't know if anybody else did this particular paper trade, this example trade in your paper account, and followed along with it. If you did and you have questions about it, now is a good time to bring those questions up as we're discussing the management of that. Let's see here. John, let's see if you got your question answered. So when the price goes up, you can make more money, but you can lose more money too, correct? When the price goes up, you can make more money. I don't know that you can make more money if it goes up. It just depends on the move. We're looking for it to break either way. We don't really care when we get into the trade. It could go up, it could go down. We're indifferent to it, okay, because we're playing both sides of it. But it just kind of a lot of times depends on how big the move is, okay? And we are typically trading things that we're expecting a big move, which is why we have this market maker move showing on here. Now, those of you that are just familiar with that, let me show you where that's coming from. If we come over here to, say, the trade tab, and I'm going to mark this out on my screen here. This is the market maker move area that's saying, okay, up or down in the neighborhood of $7.22 is what this one is saying right now, okay? That's what is reflected on the chart. If I can come back here onto the chart and we look at what the expected move is, see down here, $7.22. Okay, so that's where that information comes from. And it's essentially the at-the-money straddle for whatever the front week is or the front month, depending on the stock. All right. Let's take a look at maybe some new opportunities. We've got some really fun stocks that are announcing this week, okay, that we're going to be looking at here. When we're looking at, hey, is this maybe something that might be worth doing a straddle or a strangle, long or short? One of the things we're looking for is, in the past, does this thing move, right? So we're going to take a look at Datadog. I'm going to go out a full year so we can see basically how all their earnings have been. And actually, I'm going to add one more study here. I want us to see the implied volatility. Let's see if that came on. It did. I think maybe for the moment I'll hide the ADX and we'll focus on the implied volatility as our study. Okay, good. That's at a 5. So let's look at the furthest away earnings. Okay, so a year ago, this is when they announced their earnings. They closed here at 148.09. What happened the next day when they announced? Gapped down, ran down for a little bit, kind of rallied back towards the end of the day. It kind of is a hammerish looking type candle, right? A little head, longer body. But it did continue to drop for a while. We had this day here where maybe it might have looked like it was recovering, but did it give it a big move? Yeah, it absolutely did. The next earnings, right here, it actually didn't move that big. Okay, so not a big earner or a bigger mover for that particular earnings. What about this earnings here? We look for big gaps of big candles is what we're looking for here. So it closed here, gapped clear up here, but then it fell. It actually closed lower than where it closed the night before. But yeah, that had a huge move. These are the ones that are a little trickier to trade because you get that initial reaction and it popped clear up here, but it just didn't stay. And we don't know when it's going to stay or when it isn't. So sometimes what people will do is if they get a first big initial move, and if it, say that part of the trade is at an area where they're like, okay, I feel comfortable taking some profits here, they might choose to do that. Don't have to do that, okay? But you never know if it's going to continue to move for us or not. You know, we just have to play each trade the way it comes. And like I said on AMD, it worked out to our advantage. Would love it if all of them were quite that clean. This is one that really wasn't that time. And then let's look at the last earnings that they had. Boy, was that a big mover. That gapped clear up here, and then it continued to run for 3 days. Okay, so each one is going to be a little bit different. All right, this move here, 13.78%. We think that's a big move or a smaller move? You can just answer that to yourself. Yeah, it's a bigger move, an expected move, 13%, almost 14% for just one event. Yeah. Now, here we have the marker for where it's expected to move to. So in the neighborhood, if it goes up about $130, if it drops, maybe down here around $97, okay? Now, you might look at this and go, that doesn't look like a very big move. And part of the problem is because it was up at $200 here. And it's not nearly that price right now. And so if I were to maybe just zoom in, maybe say along here, would get maybe a better sense of how big that move potentially could be. Now, with that kind of implied volatility, do you think you want to be a seller or a buyer? Do you want to do this strategy being a buyer or a seller of a straddle or strangle? Let's take a look at another piece of information. This stock announces tomorrow on the 10th after the market closes, okay? So first day of trading that it'll respond to where the full market's engaged is going to be on Wednesday. But look at this implied volatility here. Priced into the options that expire. 170%. Whoa, that's big. And then it drops down to the next week to 114%. But this is really huge. Yeah, okay. So those of you that decided to respond to my question there, you're saying, yeah, be a seller. Yeah, seller, and then John's saying I sell calls and puts with a 30-day and a 40% delta, and that might be for maybe a regular, say, credit spread or something that you might want to go out a certain period of time to give it the time to the move. But in this case, we want to sell this puppy. Okay, we're going to be a seller here. Now, can we make more money selling a straddle or a strangle? What do you think? Can we make more money with a straddle or a strangle? Okay. If we were to do the straddle here, stock's at 112, so 113 would be our at the money. And so if we sold it, 730 is what we could bring in here, and it looks like I skipped a row, 775 here. If we sold a strangle, would be going further out of the money. We go further out of the money, then the premium is definitely smaller than selling the out the money straddle. Okay, so we are going to sell the 113 straddle. Okay, so we're going to say, all right, I'm going to hold my control key down, click on the 113th bid price, come across here, hold down my control key, click on the bid price on the call side. That's going to give us a really juicy credit there, 1632. But what's the risk of being naked in a call? or naked in a put. Put size maybe not quite so scary, but it means the stock could be put to us at whatever that strike price is. Okay. Generally, it's not necessarily as scary as the risk of as being naked a call. Naked a call has theoretically unlimited loss. Okay, you're short a call. We want the value of that to drop, but what if, say, they on their earnings it popped and it popped big? Well, being naked, man, that puts us in a position of, oh my, we could have unlimited risk potential there. So to mitigate that, what we're going to do is we're going to buy an out of the money strangle, not in this time period, but further out. Now we could come out here to 1 week away or 1 week further out, right? The implied volatility drops off quite a bit. It drops off even more if we go to, say, the February 27 weeklies. Now, sometimes these weeklies, sometimes they're liquid, sometimes they're not super liquid, okay? These ones are not like stupendously liquid, okay? So it doesn't make them a good candidate necessarily, okay, because of the sparsity of those options. But the ones that have monthly expirations generally have a lot more open interest going on, all right? So here, we're going to do, for our protection, we're going to buy a 20-something or 30-something delta, okay? Now, as we look at my delta column here, we've got some choices. We've got a 24 delta, has 2,300 contracts. It looks like we've got some new strike prices that were just introduced, which is why we have 0 open interest here. But maybe some of them starting to get some activity here with today's volume. So these didn't exist on Friday. All right, so we would maybe focus on the ones that do have a lot of open interest. So maybe this one, the 100 strike price, or maybe this 105 strike price. It has a 32 delta, but we definitely want to be looking out of the money. So let's see if the one I had decided that I thought we might use, let's see if it still looks good. I was looking at the 100 put and the 135 call. So here's our 100 put. So let's go ahead, we're gonna buy it. So I'll hold down my control key here. And then we're gonna come back down here on the call side of things. Same thing, we're looking for 20-something, maybe 30-something delta. Which ones have the open interest? I said 135, that has a lot of open interest. Now that actually goes into the teens. So, you know, maybe we could consider also doing here this 25 delta at the 130 strike price. In fact, we'll go with that one. We'll go with this 130. I take it back. I really want to keep with this 135. All right, so we will buy this one. Okay, so that takes our credit down, but is that still a pretty healthy credit? Yeah, that really is a healthy credit. And so the hedge legs that we're purchasing here really are just for protection, okay? So that we don't have a position where we have the naked call or the naked put. And so we kind of want it to be cheaper for us because it might be something we might call a throwaway option. It might just be something that's worthless. We're just using it for protection to try to collect that credit. All right, you guys are smart. Yeah, at the money, we're going to be able to receive more premium. So on that straddle than the strangle. Future dividends, let's see, I like these over a condor. All right, very good. So this is going to be trade number 1. What do we expect? Well, we expect when the earnings come out at night, Tuesday night, you might get an idea what's going on with it, right? There might be an initial reaction. So you might keep track of it that night, but really the next morning before it starts trading, that's when we maybe kind of want to see, gee, which direction does it look like it's going to go? Does it look like, you know, if the news is bad, is it a little bad or is it not, right? Is it maybe a little gap down, or maybe is it a smaller gap? Sometimes when they make short, tiny moves and they don't really move a big direction initially, sometimes you have to sit in the trade for a little bit longer to see what direction it might decide to go to, because we really do need it to move a good, decent distance, right, for us. Now we're going to go ahead, we're going to put this in our straddles and strangles bucket so that we can keep track of that. On this trade, here it says, what's the maximum loss on this trade? Let's come up here real quick. Well, this will take a moment probably to get filled here. Let me just get our, kind of see on the risk profile what this looks like. And I'm going to kind of scrunch it up here a little bit because we need to see. So up here we'll have the latest date we can put, which is the 21st. We're going to take the later of those option periods. So we're going to change that to the 21st. And I'm going to say set slices to the break even at Saturday afterwards, right? That'll be the 14th. So our peak profitability looks like it's up here at about the 113, right where we're selling that straddle. Is it realistic to think that we're probably going to get that? Not necessarily, right? That's really hard to peg it to be right exactly there come options expiration. Okay. What is our maximum loss? Well, on the downside here, looks like in the neighborhood of 228. And then on this side, it can get pretty big. Look at that. That's 974, 980, 990. Okay, and then it kind of levels out down here, maybe near 1,000. Now, that would be a tremendous move. If it went from 110 to 200, that would be just explosive. Okay, so really what we're trying to do is identify something that maybe we're just happy with the return. We're probably going to have to get rid of one side of the trade or the other. And then hopefully we're in a situation where maybe our hedge legs out here, the 130, the 135, they probably we're probably not going to get a lot of use out of them. They're really just there for protection. But if we can sell and recover a little bit of one of them, great. That would be nice. Okay. All right. So that's going to be trade number one. Did that answer your question there about how you figured that out, Harry? What the maximum loss is? It's not something you can see on the option chain, which is why it's helpful to see here. Okay. We said, what did we say? 130 is on one side where it's expected to go, right? That market maker move. That was 130, and what was that, about 97? So where's 97 here? So 97 looks like about, actually, 97 looks to be about here. Okay. So could move that direction. It could move it that far. It could move further. It could maybe not even move a lot initially. So we'll just have to really pay attention. Now, sometimes people will put in an exit order on these, but many times you're kind of wanting to see how it's going to play out, what direction it's going to go, before you maybe put in a stop loss or something like that. Okay. All right, let's take a look at another one here. Oh, there's so many good ones to choose from. Let me show you something real quick. One, a request that had come in on this class was, could we look at maybe doing some of these trades with a lower priced stock? Okay, Lyft could maybe qualify as a lower priced stock. Market maker move 12.78, but dollar wise, it's only 213. You go through and you look at the options. Yep, it's really baked into that front week, isn't it? 162%. But you really don't get a lot when you're doing the trade. Sometimes the spread is a little wide. Looks like half the money here would be 1650. So sometimes they get a little wide, and it makes it hard to really bring in a meaningful credit. Okay, so can you do it? Yes. Experiment with that in your paper money account. But there was Ford and there was Lyft, and neither one of them looked like they would really yield a lot out of the trade. So that's why we're not going to use it. All right, let's look at this one. This one could be fun. Well, there's a lot that could be fun. Let's do Spotify. All right, Spotify, been on a downtrend. Looks like about a 9.3% move, so pretty decent move. This is a more expensive stock, isn't it? It's expecting almost a $39 move. Yeah, that's pretty big. That's pretty big, isn't it? Let's go see what the options look like. So we're going to look at that front month. There's a lot of implied volatility baked into that. Yeah, there really is. When you're looking to see if, does it look like it's meaningful enough to sell? And right, if it was maybe say 5 or 10%, you might go, oh, I don't know that it's that much. But when it gets to be these bigger numbers, 20%, 30%, right, or even bigger like what we saw, then you're like, okay, yeah, that's meaningful, because this is maybe about 30, 35% maybe, or almost 40. That's a big difference. Okay. All right. We are going to look into the same strategy because it's a big move, trying to capture that premium. A lot of it's baked into this front week. So we're going to do the same thing. We're going to sell the short straddle right up front, and we're going to go out a little bit further and buy that strangle as the hedge leg. Okay. All right, 417.50. Look at that, man, right about on the nose of this guy. All right, so 417.50. I'm going to hold down my control key, and I'm going to hold down the control key and click the correct side here, the bid side here on the call. So pretty big credit. So we definitely want to do that hedge. Again, we could come out here, we could come out to this weekly or the February. Turns out it's the February monthlies that really is where the liquidity is, okay? And again, we're gonna use our delta to help us decide, how far out of the money do we wanna buy this protection? Maybe a 20-something or 30-something delta. It has the same situation here where some new strike prices have been added, but right now, there's zero open interest because they just were added today. So what are our likely choices here? We could do a 390. Some of these are way out of the money. All right, so this one is 390. This one, the 400, really has a lot of open interest here. Okay, so we'll go ahead. We'll choose the 400 that we'll buy as our hedge. So I'll click on the ask price here, and then we'll do the same thing on the call side. We're going to come out here where our delta is, our 20 or 30 something deltas here. Where do we see the open interest? Let's see which one on this one is going to be. We'll probably have to go with this one, right? Actually, that's not true. Let's go with the 460, okay? It's a 25 delta, has 152 contracts here. So it has been trading before, and we'll go ahead and we'll buy the 460 as the hedge. Now, those were kind of expensive contracts. It took our profits about in half, right? But again, pretty hefty credit. We're going to do the same thing. We're going to look for what is the earnings information. I didn't tell you the date on this one. Let's go ahead and submit this and put it in our straddles and strangles bucket here. The date on this one, it's also on the 10th after the market closes. So Wednesday morning, we're going to be a little bit busy. And sometimes I don't like to do them both on the same day. I had found some other ones that were out a little bit further we could have used. possibility. Okay, let me show you a couple of them. We're not going to do trades on them. But just so you're aware, Coinbase, oh, got to spell it right, has about a 7, almost 8% move in here. Expedia typically is a big mover. It's got 11%. Okay, down to 10.74% market maker move. So pretty big move looking at it there. And then another pretty good size one is Roku. Okay, 12%. So if you were looking to just look at some different examples this week that announced, maybe you're looking for different days, so you're not trying to do a whole bunch of things in the same morning or the same night, right? Then you might consider doing any of these if you wanted to in your paper money account, of course, so that you can practice the strategy. All right. Now, I hope all of you are following us. Cameron and I on X. I'm Connie Hill CS. Cameron May CS. We'll invite you to follow us. I hope you're also a Trader Talks subscriber. On our Trader Talks channel, you can see our content so much more just easy to find, okay? So here's some of the mug shots. There's Cameron's mug shot there. So we're in our straddles and strangles right here not tomorrow. Next up is going to be Barb trading a smaller account. A lot of you I know like that class as well. But you can see kind of what's coming up in the day. You can see some shorter videos that we call bite-sized content. They're less than 10-minute videos teaching you a certain thing. So one fun thing I did is I did one where I showed you how ThinkScript could help you find a custom candle pattern like a Cahold, okay, is what we showed you on that one. Okay, so just take advantage of that. Now, I did not see a survey out here today. If there is one, Cameron will post it again, but I did not notice one at all. But if you found this helpful and useful today, go ahead, hit the like button on your way out. That lets other people know you found some value in it, that might be something that might help them as well. All right, keep in mind these are speculative trades. Not everybody likes to do speculative trades, but these absolutely are speculative just because, you know, we don't know what direction they might go. We don't know what the news is. We all get to find out at the same time. All right. Leslie John says, do people use this when the target company is about to announce earnings? Yeah, that's what we're doing right now, right? We're using these companies because they are announcing earnings. You bet. All right. Thank you so much, everyone. Cameron, thank you for your help out in the chat. Appreciate it. All right, come back at the top of the hour where Barb Armstrong will be there with trading a smaller account. We'll see you then.